everyone, and welcome to our YouTube channel, Moneyline with Nancy at TV. In case you're not a subscriber yet, please do subscribe. Just press the subscribe button as well as turn on the notification bell so that you can get notifications when we upload our videos. Don't also forget to subscribe and join, follow, like our other social media platforms. Of course, you're seeing it right about now. Don't also forget to share this video across your platforms. Enjoy the video. Hello and welcome to the program. Good morning and thank you for joining us as always. This is Moneyline with Nancy and I'm Nancy Naji. You're wondering, is she in her usual corner? Usually you get to see me in the studio, but today I'm, in another location at bringing you this program. Today's program would be, a different kind of program. And why am I saying that? Well, we'll be bringing you shortly the decisions of the Monetary Policy Committee meeting of the Central Bank of Nigeria. I've explained many times on the program that the MPC meets generally 6 times in a year. And the main meeting just finished. Of course, the decisions are still reverberating. The governor and other members, that's the governor of the central bank now, and other members of the MPC arrived at decisions to hold the rates. You'll be getting to hear that in a couple of minutes, but the basic thing which I need you to understand is that the monetary policy rate has been retained at 27.5%. And what does that mean? The MPR, which is the monetary policy rate, is the rate, is the anchor rate, as it were. That's the basic rate. So all other rates that you see within the economy oscillates around that. When banks are going to borrow to you, they will also take from that. So they will begin from that. So I hope you understand. So what we'll be bringing you on this program today, you will get to listen to in a few minutes Governor Olayemi Cardoso, that's the governor of the Central Bank of Nigeria, telling us about the made decisions. You would also get to hear questions that were posed to him. Also on today's program, we'll be bringing you the director of the Monetary Policy Department of the Central Bank of Nigeria, Dr. Victor Oboh. I had a tete-a-tete with him just for a couple of minutes, speaking to him about the reasons behind some of these decisions, because the Monetary Policy Department is a very integral department at the Central Bank of Nigeria and quite ingrained in coming up, of course, with some of the decisions that the MPC's outcome. So you have an interesting program to watch today, as always.
The Monetary Policy Committee, MPC, of the Central Bank of Nigeria, CBN, held its 300th meeting on the 19th and 20th of May 2025. The committee reviewed developments in the global and domestic economies, including the risks to the outlook. All 12 members of the committee were in attendance. Decisions of the MPC. The committee was unanimous in its decision to hold policy and thus decided as follows. 1. Retain the MPR at 27.50%. 2. Retain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3. Retain the cash reserve ratio of deposit money banks at 50% and merchant banks at 16%. 4. Retain the liquidity ratio at 30%. Considerations. The MPC noted the relative improvements in some key macroeconomic indicators, which are expected to support the overall moderation in prices in the near to medium term. These include the progressive narrowing of the gap between the Nigeria Foreign Exchange Market (NIFEM) and Bureau de Change (BDC) windows, the positive balance of payments position, and easing price of PMS. Members also noted with satisfaction the progressive moderation in food inflation, and therefore commended the government for implementing measures to increase food supply, as well as stepping up the fight against insecurity, especially in farming communities. The MPC thus encouraged security agencies to sustain the momentum while government provides necessary inputs to farmers to further boost food production. The committee, however, acknowledged underlying inflationary pressures driven largely by high electricity prices, persistent foreign exchange demand pressure, and other legacy structural factors. The MPC noted new policies introduced by the federal government to boost local production, reduce foreign currency demand pressures, and thus lessen the pass-through to domestic prices. Given the relative stability observed in the foreign exchange market, members urged the bank to sustain the implementation of the ongoing reforms to further boost market confidence. The committee also called on the fiscal authority to strengthen current efforts at enhancing foreign exchange earnings, especially from gas, oil, and non-oil exports. The MPC, however, expressed concerns about the recent decline in crude oil prices attributable to increased production by non-OPEC members, as well as uncertainties associated with U.S. trade policy, which present new challenges for fiscal receipts and budget implementation. The committee reaffirmed the continued stability of the banking system following notable improvements in key performance indicators and observed the appreciable progress in the ongoing recapitalization exercise. Members thus called on the bank to sustain its effective oversight of the industry to ensure compliance with regulatory and macro-prudential guidelines. On the strength of these considerations, and driven by the continued uncertain policy environment exacerbated by ongoing global shocks, members weighed the available policy options and were unanimous in their decision to hold policy to enable a better understanding of near-term developments. Members reaffirmed their commitment to prioritize policies targeted at anchoring inflation expectations and easing exchange rate pressure. Key developments in the domestic and global economies. According to the National Bureau of Statistics, NBS, headline inflation year on year declined to 23.71% in April 2025 compared with 24.23% in March 2025. On a month-on-month basis, it also declined to 1.86% in April 2025 from 3.9% in the previous month. Both food and core components contributed to the decline in inflation in the period. Food inflation eased further to 21.26% in April 2025 from 21.79% in the previous period. Core inflation also declined to 23.39% in April 2025 compared with 24.43% in March. Real GDP year on year grew by 3.84% in the fourth quarter of 2024 compared with 3.46% in the preceding quarter. This improvement was driven by both the oil and non-oil sectors, with the services sector being the major contributor. Gross external reserves increased by 2.85% to $38.90 billion as at 16th of May 2025 from $37.82 billion at end of March 2025. This represents an import cover of 7.6 months for goods and services. The balance of payments recorded a surplus of $1.10 billion in the fourth quarter of 2024 compared with $4.21 billion in the preceding quarter on account of moderation in current account surplus. Although global output growth is expected to remain positive despite existing and emerging headwinds, the International Monetary Fund, IMF, downgraded its global growth forecast to 2.8% in 2025 and 3% in 2026, compared with 3.3% in 2024 due to the uncertain policy environment. Members were thus unanimous in their resolution to maintain close surveillance of developments in both the domestic and global environments to enable appropriate policy response to emerging shocks. The next meeting of the committee is scheduled to hold on the 21st and 22nd of July 2025. Thank you.
All right, welcome back. At this point, let's just dive right in. You get to listen to Mr. Olayemi Cardoso, Governor of the Central Bank of Nigeria, read to us his decisions, as the outcomes of the two-day policy meetings, why those decisions were taken, and indeed the questions.
The real question actually is that if the numbers say we are on the right track, he still does not feel that we are on the right track for Nigerians. How do Nigerians interpret this into meaningful impacts? That is my question to you, Mr. Governor, because inflation is still rising, prices are still there, Nigerians are still, it's still hard for many of us living in the country.
First of all, let me make the comment that the Fitch upgrade is particularly important because it was coming at a time where there were global economic headwinds and shocks, and there was a lot of uncertainty. So it's important for us to realize that in spite of all that, there was a move by Fitch to upgrade. And I think that is a very, very positive signal. It's a very, very positive measure. Now, in terms of how this whole macroeconomic fundamentals are playing out, in spite of the fact, like you said, there have been positive endorsements from all kinds of bodies that make it a point of duty to observe and critique the moves that various countries are making to ensure they have stability in their economies. And your question basically is, well, that may seem positive, but how does that translate to getting the feeling that things are better? Now, I think it's important to say that investors, and let's face it, without investments, economies don't grow. Investors don't go to where there's instability. So I think that is the first thing to understand. On the journey, and this is a journey, investors don't go out to invest to lose money. They go out to invest because there's stability in an economy and they can plan. With that stability comes confidence. With confidence comes investment. And with investment comes growth and outputs. I think that's definitely the trajectory that you will find in all countries of the world. We obviously have been through a long period of instability. And I think that clearly what is being recognized is that the Nigerian economy is now stable and there's interest in those who want to invest to now invest. Clearly, the inflation numbers themselves speak for themselves, and I've discussed that here, I've mentioned that here, they speak for themselves. The overall trajectory is in the right direction. Not one particular aspect of managing the economy is a bullet that will solve all the problems. It isn't. It's a multiplicity of different endeavors. And that is why the combination of the efforts that are being made and are yielding results in terms of stability. And don't forget, the central bank is the custodian of stability in an economy. If you look at the exchange rate, for example, volatility has reduced from over 4% a year ago to less than half of 1% around now. So that's an indication of stability. And with the increasing collaboration between the fiscal and the monetary side, definitely the journey that we are going through will begin to yield greater results as time goes on. I have no doubt about that. On the issue of depreciation of the currency, which obviously everybody is always very interested in, the way I will put it is to say that if you look at and make the comparison between Nigeria during the last month or so, month or two, when the whole issue of global tensions got heightened. And let's face it, right now we're in a period of heightened uncertainty. And if you are all observing, you'll find that the various currencies of the world were under attack and were having to defend themselves. You find that relative to other countries, Nigeria came out very well indeed. We were able to ensure that our depreciation was very, very modest and that the stability was pretty much there. And that, in my view, was a reflection of a lot of the measures that we had taken prior to this time to stabilize our economy. I dare say that if those actions had not been taken when they were, the results would have been a lot more disastrous. Well, it would have been not even more, it would have been disastrous for us. They would have been disastrous for us. So it's a good thing that we started these reforms early and that we stayed the course to the point where we built buffers which are able to withstand shocks that come in. And that really sort of dovetails into your issue of reserves. As with our reserves, and here again, it may be necessary to just make a slight digression to re-emphasize what I'm about to say. We published our reserve numbers recently. And if you observe there, our reserve numbers went up from net reserves now, net reserves, went up from slightly over 3 billion US to about 23 billion US, which was a quantum leap in our reserve position. Okay. Again, I would say that all these are happening as a result of transparency in process, ongoing reforms which are giving confidence to many players in that industry who perhaps had been on the sidelines up to that point in time, and are bringing about the results. And I always say that the numbers speak for themselves. Beyond the gross reserves, which are 40 billion as at that time, the net reserves have grown quantumly. And that will continue to be, and that will continue the path whereby we will ensure that we have sufficient buffers beyond the IMF 6-month import cover to ensure that we continue to keep our economy in a safe and sound mood. The sustainability of the surplus you talk about, and again, I must say, I must comment that in itself speaks volumes, because you have a situation where beyond just oil prices, in fact, if you look at the oil sector itself, you'll find that the importation had gone down with the Dangote refinery and all the other refineries coming up. The demand obviously will go down. The gas exports have, been on an upward trajectory. Now that we have a competitive currency, and it's something that you will hear me talk about over and over and over again. Our currency now is more competitive. So this should encourage exports. And indeed, for us as Nigeria and Nigerian businessmen, the opportunity to extend that dragnet into our sub-region is also an enormous opportunity now that we have such a competitive currency. So to answer your question, my belief is that if we continue doing the things we have done up to this point in time that have resulted in a positive surplus, we should be able to, in fact, improve that without too much of a problem. At the central bank, we are on a mission to restore confidence and build back trust. We're in a mission to restore confidence and build back trust. And we appreciate the fact that in this journey, we need all stakeholders to find that they are dealing with a central bank that will not disappoint. And that is the reason why some of the things we did and we have done up to this point in time, it may seem like nothing, but it's a big deal. For example, when we talk about publishing our net reserves figure and doing it, there's a reason why these things happen. People have to know that when the central bank says it is going to do something, it does it. We recognize that there's a need to rebuild our institution, the central bank. We recognize that. And I assure you that we are doing everything possible to ensure that that happens. It isn't something that will happen overnight. It's not possible. There are a lot of areas that we literally need to reset completely and start all over again. And we're doing so. But those things do take time. They do take time. But what I want to assure you is that we will be consistent as we have been over the past 18 months. And we believe that once we continue in that direction, we will be successful in building back the trust that has been so badly eroded over a period of time. I'm happy and pleased, I must say, that particularly in the international arena, and you mentioned it, both the IMF and World Bank meetings, and the very successful outing that we had in the NASDAQ building in New York. The feedback from those particular engagements have been very positive. And I recall that there was the person that moderated one of these sessions was quoted as saying that they have been covering these activities in Nigeria for so many years. And this is the first time that they have seen so much interest in investors coming to Nigeria, that it is no longer a question of should we be there. It is a question of when we will be there. One of the questions is what prompted this decision? And I want to say, for the avoidance of doubt, that this is something that has been a long time coming. It should have come earlier. But in any case, be that as it may, it couldn't be coming at a better time. And the reason is as follows. As I had said earlier, we have a relatively more competitive currency. There's already a lot of trading that takes place, especially in the sub-region. Okay, a lot of trading takes place there. And much of what you find is that those who trade in that route are subjected to enormous risks. Doing it with a payment system that is secure and safe will eliminate those risks. You know, one of the outcomes of the discussions we held at the spring meetings and also in New York was obviously the concern with respect to tariffs and the impact that tariffs have on economies. And increasingly, the discussion started to come up that various countries should see means of collaborating, okay, amongst themselves, particularly on a regional level. So I believe that having a payment system that is safe, secure, and can be relied on is a step in that direction. It will automatically put people who up to this point in time, as I said, had used risky means, moving physical cash from one place to the other, that's all gone. And I realize also that sometimes it takes a while for people to test these systems and to have confidence in them, which is understandable. But I just want to say that, you know, they don't have to. Okay, and that if that payment system is well ingrained with the openness of economies, especially now that we know that the risks to global trade have become a lot more uncertain, this could be a means of ensuring that the catalyst for trade in the sub-region is set alight. What the major takes should not be, because sometimes there's a tendency for people to misunderstand certain things. The central bank is not a commercial bank. And for that reason, I wouldn't want those who are looking at our financials to compare the indices of the central bank with the indices of other banks. I wouldn't want that. And if you think about it, it is for good reason that you typically only have one central bank in any country. You don't have two. It's for good reason. Okay. So I think it is important that in terms of takeaways, one of the first major takeaways is transparency, accountability. We must publish our numbers. That's the law. And so we do. Okay? And so we do. We must publish our numbers. And we did that. So that in itself should give confidence to everybody that the central bank is walking the talk. Those who make it a point of duty to understand the complexities of a central bank and its operations are really free to discuss, to come, to ask questions, and they do. So that is something that we are very, very open to continuous engagement. And as I said, they do. The other thing that is important takeaway is that this should help to validate certain things that we say during the course of the year. Again, the net reserves figure. I recall when it was first published, there were some skeptics who felt, oh, they will only believe it when they see the audited financial statements. Well, so the audited financial statements are there. So as I said, this also helps to validate certain things that go on within the central bank and also to show something we continue to talk about. That is the uncompromising stance that the CBN has taken with respect to the way of travel with respect to orthodox monetary policies. Okay, if we're not employing orthodox monetary policies, you will know. So these are all part of the takeaways, important as it is, but again, as I said, it should give you confidence in the fact that we are walking the talk. If we are supposed to be producing our statements on a regular basis, we are doing so. It gives a better sense for those who dig down into it to have an appreciation of the challenges that this central bank inherited 18 months ago. For example, if you compare the numbers for 2023, you see a huge loss of over 1 trillion naira. And within a year, it had been moderated to about 30 odd billion naira. That, again, as I said, gives an indication of the extent of the challenges that the central bank has been through over the past 18 months or so. Yes, I agree. There is a trust deficit. I fully agree. And we need to understand where this trust deficit is coming from. Okay. Now, on average, 7% to repatriate money from overseas to Nigeria and to many emerging market economies. Clearly unacceptable. Totally unacceptable. And it is something that I was so concerned about that at the last spring meetings, I actually took it up with the president of the World Bank, and I solicited his cooperation and ideas as to how we can bring this down. One of the areas that is clear to me is what we are starting to do now, which is volume. It's a volume business, really. And I think we're heading in that direction. And I believe, honestly, for those of you who were not there, the recent bold step we have taken with the NRBVN is a game changer. It is really a game changer. It is something that the diasporans have been waiting for, and now that they are going to be able to transact their business from overseas relatively seamlessly, the opportunity for them to invest in the country of their birth is now limitless. And I think it couldn't be coming at a better time for them. It could not be coming at a better time for them. However, that does not bridge the trust deficit you referred to. I think fundamentally, there are certain things that do need to be done to ensure that that trust deficit is bridged. And top of the list, in my view, is KYC. We've got to be able to ensure that we have a strong and very robust system in place that screens those who are coming to use these facilities. And that, in conjunction with NIBS, has already started. To ensure the response has been very good, but care is being taken to ensure that we do not get ourselves into any trouble. And hand in hand with that is the need to get off the FATF list as well. You see, by the time you're doing things like this, those who would send money back are more comfortable. They are more comfortable in embracing the products that are there.
All right, welcome back again. Let's now bring you the interview that I had, just a little chat, I will say that I had with the director of the Monetary Policy Department of the Central Bank of Nigeria. And I must say this is the first, his first on the program, Dr. Victor Oboh. Just take a listen to his answers around why the MPC came up with these decisions, because now we've seen the MPC in a hold stance, because the last two meetings, the MPR has been is being steady. So perhaps we're seeing a more dovish central bank now, but who knows? Let's see what happens. I also asked him questions around why inflation is still biting despite the efforts of the central bank, and question around balancing price stability and supporting economic growth. Take a listen.
I say hi to all Nigerians. The Monetary Policy Committee of the Central Bank met today, and the governor has already conveyed the decisions of the committee. And by that announcement, all the parameters were retained. The MPR at 27.5%, the liquidity ratio at 30%, the corridor is left at plus 500 and minus 100 basis points around the MPR. And what that has got to do is based on the data that is available. Don't forget that the present management of the bank is completely data-driven, and all their decisions are evidence-based. After a thorough assessment of developments, both at the global and domestic level, the committee found it expedient to retain all the rates. Now, there have been some remarkable improvements in the economy, and this has shown in several areas. For example, the exchange rate market has been relatively stable, because when you compare Nigeria with what happened in other economies, this is actually a volatile period. And that volatility is driven from what happened at the global environment, especially the trade war. And this has introduced a lot of uncertainty across the world, especially in emerging markets. We've seen huge outflows of capital from emerging markets. But the good thing about us in Nigeria is that because of the strong economic fundamental that this management has begun to build over time, the impact on us has been minimal. So we should not take, we should take cognizance of the development at the global environment. And all that has been done. We are also aware of some headwinds, including the drop in oil price, which again poses a threat. So what MPC has done is to say, look, we need to see what has happened over time. The economy needs to digest the impact of previous rate hikes, despite some headwinds from the global environment. The direction of policy at the global level at this moment is unclear. We are aware of negotiations between the U.S. and its trading partners. Of course, the second round effect is something we need to be wary of. So because of the totality of all these headwinds, the MPC thought that the policy environment at the global level remain largely unclear, and they need to pause and study the direction of policy at the global level. Even the U.S. that took just a recent monetary policy decision also had to hold to be able to understand the direction of policy. That is one. Number two, the Monetary Policy Committee thought it necessary for the impact of previous rate hikes to be able to, dissipate permeate through the economy, and believe that the general moderation we have seen in prices will stabilize, so that we will see gradual and progressive decline in prices. Don't forget that our primary mandate is price stability. And the price stability mandate that we pursue is in the interest of Nigerians. So those two major considerations inform the decision of the monetary policy to ensure that the rates are held, so that the impact of previous hikes permeate through the economy to be able to result in further moderation in price. And then they need to watch the ensuing headwinds from the global environment so that we take decisions that are in sync with the policy directions. Now, the public and of course the Nigerian community will need to know that the mandate of price stability in itself is in the interest of the citizens. What is our mandate? Our mandate is to maintain a stable price regime that is conducive for economic growth. So if we are not pursuing a robust economic growth, then we are not contributing to the economy. So actually the purpose of ensuring stable price is to create a conducive environment for the economy to grow. So you will see that inflation is harmful both to the economy and the citizens at large. So it is very important to face the fight against inflation headlong. And that is why the management of the bank at this point in time reverted to orthodox monetary policy. Orthodox in the sense that orthodox monetary policy is more effective in arresting inflation. Now, all the effort that has happened in the life of this administration is geared towards reducing inflation. And a lot has been achieved. Now, let us know that if there is a counterfactual analysis, and by counterfactual analysis, I mean that supposing these efforts, these rate hikes, have not been implemented, where would our inflation numbers be? Then you will now appreciate the effort of the present management of the bank. So we will need to know that these rate hikes, this tight monetary policy, is what has moderated inflation to this level. That's point number one. The other point is that in economic theory, inflation generally is downward sticky. Once inflation has gone very high, it takes time for it to moderate. And the good news about us is that the moderation has been gradual. And we are hopeful that with this tightness, we will get there and be able to achieve that rate that will be conducive for us. So what I would like to appeal to Nigerians is that, yes, the bank is aware of the high level of inflation, but every effort is being done to make sure that it trickles down, and good enough is moderating generally. Now, we also need to be comforted by the fact that the drivers of inflation are things that we analyze day in, day out. One of the major drivers of inflation in Nigeria is food prices. But consistently from January to April, that driver of inflation has trended consistently downward. You can check the numbers. That is comforting in the sense that if we're able to lay hold of that major contributor to headline inflation, it means that we have a promising future, that in the near to medium term, headline inflation will respond. And you can see the numbers, and it shows very clearly that we are on a journey to a moderated level of inflation in the near term. So it is quite better to bear the immediate pains so that we will be able to arrest inflation, and then every other thing will fall in place for the economy and businesses to thrive. The issue about the trade-off between monetary policy and growth is a delicate one, just as you have mentioned. But we also take cognizance of the fact that even though our primary mandate is price stability, we are operating one economy with the fiscal sector. And so while we ensure that prices come down and price stability is achieved, we also have a handshake with the fiscal. That is why there's need for fiscal monetary policy coordination to ensure that the trade-off is minimized as much as possible, and we work in the interest of the Nigerian citizens, the Nigerian economy as a whole. Now, what happened is that at the monetary policy level, we are also aware, as I've mentioned before, that our role and objective is central to growth. Growth does not thrive when inflation is very high. Inflation in itself hurts growth. It's not conducive. High inflation is not very conducive for growth. Because when inflation is high, the prices are high, it means that the factors of production, the prices of factors of production are also high. Raw materials are high to come by. Importation of those raw materials that will be used for production processes, the prices are high. During high inflation, workers will demand for wage increase, which is not good for the production sector. So inflation in itself is also harmful to growth. And that is why we feel that if you are able to have a firm control on inflation, it is equally beneficial to growth. So you can see the link. So what we do in terms of maintaining a balance is that we look at both ways to ensure that one does not suffer. But if you look at the two, it is important to ensure that you arrest inflation. Now, the pursuit to get inflation under control is not an objective that you pursue throughout. So the sacrifices that Nigerians will be paying now is in the short term to be able to get inflation right, and then we'll be able to support growth maximally. But the good news is that in spite of the tight monetary policy, because we are trying to maintain a balance, our GDP figures have not been disappointing. And that again is to show that balance that we try to ensure that is in place between the fiscal and monetary policy. Jumpstart our GDP numbers in sync with the growing population. Yes. So all we are doing is to ensure that a conducive environment, macroeconomic environment, is provided for those GDP numbers to double.
And that's the show for today. Thank you all for joining us as always. All you need to do also is to follow us on all our social media platforms in case you're not doing that. You can subscribe to our YouTube channel, Moneyline with Nancy TV, where you get to watch insightful interviews that would inspire you and, inspire your financial wellness, I must say. Like I always say, be the best you can be and be the change that you want to see. I am Nancy Naji. Bye for now. Thank you for making it up to this minute watching the video. Thank you all. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV. Like, follow all our other social media platforms where we keep you up to speed with fantastic interviews, as well as markets, personal finance, business, and economy information. This is the best place to be. I'll see you all again in the next video.